What's up, everybody? This is Sunko, the Korean bro. Today is 2022, November 24th. Now it's 11:47 at night, Thursday night. But I really wanted to do YouTube live, so I turned it on. Uh, let's see what we have tonight. Last night we had a lot of events, crude oil inventories, and initial jobless claims, core durable goods orders from United States. Um, and let's look at some of important events here. Mm, okay. First, U.S. initial jobless claims. U.S. initial jobless claims hit 3 month high of 240,000. Jobless claims. We all know what jobless claims is. If jobless claims goes up, that means not many people works in the states, which means uh, worse recession is coming, right? Because less people work. Let's read this article first. The number of people making initial claims for unemployment benefits rose by more than expected to a 3 month high, adding to increasingly clear signs that the labor market is cooling in response to the Federal Reserve's sequence of big hikes in interest rates. Okay. The Bureau of Labor Statistics said initial jobless claims rose to 240,000 last week from 223,000 the previous week. That's the highest number since August, when the numbers were distorted by maintenance schedules at the auto industry. The rolling 4 week average for initial claims, which smoothed out some of the series volatility, rose to 226,750, the highest since September. Continuing claims also rose by 48,000, more than expected, to 1.551 million. The trend in claims is now rising gently as firms come under increasing pressure from the Fed's aggressive tightening. As firms get so much pressure from companies, they hire less people. Instead, they fire people. Mm. Wrote in a note to clients, pointing to other indicators such as the Challenger Monthly Job Cut Survey. Mm. Okay. What about crude oil inventories? That's an important sign too. Okay. Oil prices fell Thursday. It fell Thursday, okay? Continuing the previous session sell-off as the market digests the possibility of a higher than expected price cap on Russian crude. U.S. crude future traded 0.2% lower at $77.81 a barrel. Weighing heavily on the crude market was the news that the group of 7 major industrialized nations were looking at a cap on Russian seaborne oil at $65 to $70 a barrel, above the level that had been expected when the group first proposed the idea as a way of punishing Moscow for the war in Ukraine. Okay. Probably the results about crude oil inventories didn't really have much effect on the market in general. So it doesn't really say much about its impact on the market. Instead, it's talking about different things. Mm. Okay, let's get to Motley Fool. Oh well, before we move on, let's read articles about the events that we had last night. In the article, three things investors should be thankful for. Is there any article about last night events? Mm-hmm, mm-hmm. Well, it doesn't really much say about the events that we had last night. Um, okay, let's read this first because from what I see, Yahoo Finance mostly talks about macroeconomic point of view. So let's look at this first, and then let's move on to motleyfool.com. Okay, so that we can um, start from the big category and then go on to smaller category. So, okay. This has been a long trying year for investors. Crypto got blown up at the hands of nefarious actors, blah, blah, blah. And okay, here are three things that stand out to us. It seems like economists have been calling for a recession all year, but a technical recession hasn't happened. On the contrary, according to the Atlanta Federal Reserve GDP, the economy is slated to grow a robust 4.3% in the fourth quarter. Nobody wants recessions, so be thankful we aren't in one. The tech route, which is actually a good thing. Okay, this may seem counterintuitive, but be thankful that the FANG complex has lost billions of dollars in market value this year as the Federal Reserve has moved to hike interest rates. Okay, why? Two reasons. Okay, first, it taught investors a valuable lesson. Even mighty tech companies don't have stock prices; they go up in a straight line forever. Okay. Second, the ground is arguably set for big rallies in these stocks over the next decade now that the valuations have been flushed and the cost structures reset. Okay. Be thankful that inflation has started to roll over. Cheaper stuff is on the rise, okay? The latest CPI index shows that inflation grew 7.7% over the past 12 months, the smallest 12-month increase since the period ending January 2022. Um, oh, uh, I cannot evaluate, but I don't really buy this article. I was expecting to read a quality article, but it's not as good as I had thought it would be. So, uh, I'll just move on and read articles from Malif. Okay. One growth stock down 76% could soar in 2023, according to Wall Street. Hmm. Okay. Five surefire stocks that can generate life-changing wealth in 20 years. Two growth stock owners are buying hand over fist, not the bear market. Uh, AV give you okay. Okay, let's first start with this one. Okay. Mm. Now that we know Why Warren Buffett doesn't worry about election results? Buffett has seen many presidents come and go during his time, and yet he has remained invested in the stock market. If you're a long-term investor, one or two-term president won't have a large impact in the grand scheme of things. Fundamentals and the strength of the business should be the key criteria in determining where to invest. Fundamentals and the strength of business should be the key criteria. So, based on his experience, no matter, uh, well, the one who gets elected does not matter because what matters is the business itself and mm, fundamental aspect is much more important than who gets elected. So, oh yeah, here it is. Buffett simply bets on America. Investors shouldn't give too much importance to the recent midterm elections. Billionaire investor Warren Buffett has been investing in stocks for decades and has seen many presidents come and go during that time. And if you are investing for the long haul, you have to be prepared for a reality that your preferred party won't always be in power. You don't need to get in and out of stocks depending on the election results or changes in power. Buffett hasn't let it affect his long-term strategy, and investors would do well to follow a similar approach. Buffett has said in the past that politics don't necessarily weigh on his investing decisions. I won't say if my candidate doesn't win, and probably half the time they haven't. I'm going to take my ball and go home. In general, Buffett is just bullish on America and the economy's ability to continue growing and progressing over the long term. Presidents, after all, can serve just 2 terms. So unless you're investing for a short term frame, then that there can still be time for your investments to bounce back if policies during that stretch negatively impacted business in your portfolio. So as a Buffett is a long-term investor. So uh to the most, one president will be serving country for two consecutive times. So there are there are many opportunities and many moments where stock bounces back. So here it is. Unless you're investing for a short time frame, then that there can still be time for your investments to bounce back if policies during that stretch negatively impacted business in your portfolio. So that's what that means. Investors should focus on fundamentals, not elections. Yes, there it is. Even if an election turns out favorably, that still doesn't guarantee that certain policies will be put in place or that certain stocks will soar. Take the cannabis industry as an example. When President Biden won the 2020 election, shares of pot stock took off on expectation that marijuana reform would be inevitable. In November 2020, shares of cannabis producer Tyler Brands skyrocketed 58%. But no significant marijuana reform has taken place since then, and now with the Republican Party regaining control of the House, it may be difficult for anything to happen over the next 2 years. Okay, that's what it is. Okay, let's focus on fundamental. That's what it is, right? Uh, okay. One growth stock down 76%. They could soar into that according to Wall Street. Okay, Yahoo Finance, Confluent, right? Confluent is one of the few companies that have consistently increased their guidance this year. The company is benefiting from the adoption of cloud computing, which has laid the foundations for data streaming. One Wall Street investment bank think Confluent stock could soar 147%. Confluent has upgraded forecast for year three times, which could be a sign of things to come in 2023. When the stock market suffers from broad losses, it's often a good time to scan for potential opportunities. History suggests the market always recovers over the long term, and since the Nasdaq 100 technology index remains in bear territory, with a year-to-date loss of 27%, investors have no shortage of discounted stocks to choose from. But what should they look for? Companies that offer products and services that remain in hot demand despite the weak economy are a good place to start, particularly those that continue to beat and raise their own forecast. Confluent takes those boxes, but if that's not enough, one Wall Street investment bank thinks its stock could soar 147% over the next 12 to 18 months. Here's why it's a great buy going into 2023. Okay. Need data streaming. Okay. What is data streaming? It has several applications, but its core, it involves delivering live real-time data, whether it's to a customer or whether it's for internal purposes to help improve workflows. Its necessity has grown from the widespread adoption of cloud computing, which has shifted companies' touch points with consumers online, along with most of their operations. Consumers are used to real time experiences when they are interacting with a business digitally. So anything less is often detrimental to that business sales. Waiting late times or general delays have grown to become unacceptable. Take a sports betting mobile application, for example, where the stakes are incredibly high. Data streaming can be used to deliver betting odds to the end user during a live sporting event, which opens the door to more opportunities for that sports book to accept wagers. These odds need to be calculated and streamed to the customer within seconds of a live event occurring. The failure to do so could result in a loss of business to a rival platform. But many companies use data streaming behind the scenes too. Domino's Pizza is a good case study, because it uses Apache Kafka and Confluent to give franchise owners a real-time overview of exactly what's happening in store. It means technical problems are discovered almost immediately and fixed far more quickly than if they were later identified through a prolonged drop in sales, for example. Okay. So if real-time data is streamed real time, then it's much easier for people to find out problems and they can take action right away. Um, and like for example, if people are using a batting platform, they could see uh, batting odds quickly, right? Hmm. No economic slowdown for Confluent. Okay, Confluent's recent financial results for the third quarter of 2022 were positive by just about every metric. The company crushed its own prior revenue guidance, and it also reported a much smaller loss than it was expecting. One of the biggest numbers of the report was Confluent's remaining performance obligations, which soared at 72% year over year to $663.5 million. RPOs represent the company's pipeline of work, and they typically convert into revenue over time, which indicates that this recent run of success probably won't slow down anytime soon. Okay, what's for sure is Confluent's revenue goes up continuously. Much of Confluent's growth is coming from large organizations. It now has 921 customers spending at least $100,000 annually with the company, up 39% from 664 customers a year ago, which further highlights how critical data streaming has become. Wall Street is bullish on Confluent stock. Confluent has become a popular name on Wall Street. Of the 19 analysts tracked by the Wall Street Journal, 11 have given Confluent stock the highest possible buy rating. The other eight are in the neutral camp, and not a single analyst recommends selling. But in terms of potential upside, one investment bank is more bullish than the rest. Stock is coming off a low base, having lost 76% of its value from its all-time high. One of the few still consistently raising its forecast in the face of weakening economy. Only expand in scope and importance over time, so Confluent could be in the early on innings of a very promising growth story. Okay, I'll keep that in mind. Confluent. Okay. Let's look at Zoom again. It's the stock that I've been looking at it like over and over. Uh, its price level is 76.14. Its all-time high was 492. Is now the perfect time to buy Zoom stock. It's what it is. Okay. Zoom grew revenue just 5% last quarter or 7%, excluding the effects of the US dollar's record rise. Issues remain with its small businesses and individual subscriber base, but enterprise customers are still growing. Shares remain cheap if Zoom can fix some of its problems next year and currency headwinds ease up. So if some of the issues are solved, then its price level will go up. That's what it is. If they can solve currency, uh, and if they can fix some of their own problems, it could go up. Just as the churn rate for its small business individual segment starts to ease, Zoom's enterprise segment is getting negatively impacted by a weakening global economy. The US dollar's impact on international sales isn't finished just yet, and big enterprise customers are thinking twice before quickly signing up for new video and work collaboration services, making it increasingly likely that Zoom is not in more than a mid single digit percentage growth company once again next year. Hmm. After the last earnings update, Zoom stock trades for 18.3 times trailing 12-month free cash flow. High growth cloud software with steady results and share repurchases certainly make the current price tag fair. When the company can finally get a handle on its online subscriber problem, US dollar stops eating into sales. Zoom might even be called cheap. Okay. Hmm. Hmm. Three stocks you'll be thankful to own in 2023. Airbnb, Alphabet, and Amazon. Let's look at Airbnb. Airbnb. Hmm, okay. Hmm. Five surefire stocks that can generate life-changing wealth in 20 years. Palmatic, PayPal Holdings, Lovesat, Berkshire Hathaway. Hmm. Okay, let's read this loudly, and then after that I'm going to sleep. Okay. It's already 12:15 at night, so it's getting really late. Okay. The first game-changing company that can help investors seriously grow their investment portfolio over the next 2 decades is China-based electric vehicle manufacturer NIO. Despite historically high inflation, China's zero COVID-19 strategy and supply chain issues weighing on automakers. COVID-19 strategy and supply chain issues weighed on automakers. The growth trajectory for EVs and NIO's innovation make it a no-brainer buy. China is the world's number one auto market, yet EV market share within China remains up for grabs. Based on an estimate from the China Society of Automotive Engineers, more than half of all new vehicles sold in China by 2035 should be new energy vehicles. More than half of all new vehicles sold in China, okay, with EVs leading the charge. Okay, once supply chain issues ease, NIO should have no trouble quickly ramping up production. On the innovation front, NIO is being driven by the introduction of more than a half dozen EV models. The recently introduced ET7 and ET5 sedans, which respectively began deliveries in March and September, are going head to head with Tesla's flagship Model 3 and can handily outpace the world's largest automaker in terms of range. The mid-size ET5 in particular should help accelerate NIO sales during the fourth quarter. Furthermore, NIO is utilizing unconventional methods to position itself for long-term success. The company's battery as a service subscription reduces the purchase price of its EVs and allows buyers to upgrade their batteries at a later date. In exchange for giving up some near-term revenue, NIO is looking in the loyalty of its early buyers and generating sustained high-margin subscription revenue. Okay, interesting. Interesting point of view. Instead of installing a battery, expensive battery into vehicle, uh, they let customer do it. Uh, uh, if customer wants to have a good, expensive battery, then it's their will. Mm. If they want to have a cheap battery, then it's their will. So it depends on the choice they make. So it's about loyalty. Uh, Next one we have is a Palmatic. For something a bit more off the radar, consider ad tech stock Palmatic as an innovator that can deliver phenomenal returns over the coming 20 years. All the advertising stocks have been hit hard in 2022. You can rest assured that the ad industry isn't going anywhere. On a macro basis, it's important to recognize that patient investors tend to do very well with ad-driven stocks. Okay, now it's getting really late, so I feel like I have to go to sleep. I'll do it tomorrow. I'll come back here again, okay? See you and bye bye. It's 12:19 midnight, so bye bye.